Hello, and welcome to EPK Capital's daily market briefing for Tuesday, October 21, 2025, and in the next few minutes, I will be analyzing all the major market-moving events from the last 24 hours. We'll cover the major indices, key macroeconomic drivers, political commentary, and the latest from the world of cryptocurrency. Let's get straight to the numbers. The closing bell. A snapshot of the indices. The market kicked off the week on a decidedly positive note, with a strong risk-on rally in the United States, which has since carried over into the Asian session. Starting in the U.S., all three major indices closed deep in the green on Monday. The S&P 500 climbed 71.12 points, a gain of 1.1%, to close at 6,735.13. The Dow Jones Industrial Average saw a significant jump, adding 515.97 points, also up 1.1%, to end the day at 46,706.58. The tech-heavy Nasdaq Composite was the leader, surging 1.4%, or 310.57 points, to close at 22,990.54. It wasn't just large caps, small caps also participated. The Russell 2000 index climbed 1.9% to finish at 2,499.91. This positive sentiment was mirrored in Europe. In Germany, the DAX index had a very strong session, closing up 1.8% to reach 24,258.80. And in London, the FTSE 100 added 0.5%, closing at 9,403.57. That momentum has rolled into the Asian markets this morning. The big story is Japan, where the Nikkei 225 has rallied significantly, briefly breaching the milestone 50,000 level for the first time in history. In Hong Kong, the Hang Seng Index is also showing strong gains, up around 1.7% in midday trading. So, what is driving this widespread optimism? It appears to be a combination of strong corporate fundamentals and a thawing of geopolitical tensions. Macro drivers. Tech leads, oil slides. The primary driver for yesterday's U.S. rally was not a major economic data release. In fact, the economic calendar was notably quiet. Instead, the market was fueled by optimism in the technology sector and anticipation for a strong earnings week. The Apple effect. The main catalyst was Apple. Shares of the tech giant surged 3.9% to hit a new all-time high. This move was triggered by reports indicating exceptionally strong demand for its new iPhone 17 series, with sales reportedly outpacing the previous model in the critical U.S. and China markets. When a stock the size of Apple moves that decisively, it tends to lift the entire market, especially the S&P 500 and the Nasdaq, where it holds significant weight. Other market movers. This tech optimism spilled over into other names. Super Microcomputer, SMCI, popped 5.5%. Natural gas producers also had a strong day, with Expand Energy, X, surging 6% on forecasts for colder weather. However, it wasn't a universal rally. AppLovin, App, was the S&P 500's biggest loser, dropping 5.6% following reports of an intensifying SEC investigation into its data collection practices. Oracle, ORCL, also fell 5%, as analysts raised concerns about the high capital expenditure required to meet its lofty AI-driven growth targets. And we saw weakness in data storage, with Seagate and Western Digital falling 4.9% and 3.7%, respectively. On the earnings front, Cleveland-Cliffs reported its third quarter results. While the steelmaker posted a net loss of $234 million, this was seen as an improvement from its second quarter loss, providing some stability to the stock. Treasuries, gold, and oil. A mixed macro picture beyond equities. The macro environment is sending some conflicting signals. Bonds. The U.S. 10-year Treasury yield, a benchmark for global borrowing costs, pulled back slightly to 3.98%. This is near a 6-month low. Typically, yields fall when investors seek safety, which contrasts with the risk-on rally we saw in stocks. Gold. This safety trade is even more apparent in commodities. Gold futures jumped over 4% yesterday, settling at $4,385 an ounce. The precious metal is trading near its recent record high of $4,392. Crude oil. In sharp contrast, energy prices are falling. West Texas Intermediate, WTI, crude ticked lower to $57.50 a barrel. Oil is now down nearly 3% over the last 5 sessions and is hovering near its yearly lows. This weakness is being driven by concerns over slowing global demand, compounded by worries about a potential U.S. China trade conflict and reports of rising supply. So, why are stocks rallying while safe haven assets like bonds and gold are also in high demand? The answer appears to be the major political overhang in Washington. Political front. Shutdown, stalemate and trade optimism. The biggest political and economic story in the U.S. remains the federal government shutdown, which is now entering its 20th day. This ongoing gridlock is what's likely pushing investors into safe havens like gold, even as they buy stocks. The shutdown has created a bizarre, bad news is good news scenario, where the political dysfunction increases the market's belief that the Federal Reserve will be unable to raise interest rates, or may even be forced to cut them. The political rhetoric from Monday highlighted the deep divide. Senate Minority Leader Chuck Schumer placed the blame squarely on the opposition, stating, "Republicans need to wake up from whatever dream they're in," and called it Donald Trump's government shutdown. In response, Senate Majority Leader John Thune drew a line in the sand, commenting, "We're not going to negotiate on anything until Democrats stop holding government funding hostage." Meanwhile, Representative Hakeem Jeffries suggested a path forward, stating that Donald Trump definitively needs to get involved to break the stalemate. This U.S. political turmoil is one half of the global story. The other half, which is driving the massive rally in Asia, is a new wave of optimism on U.S. China trade. Overnight, comments from Donald Trump emerged in which he downplayed concerns over potential friction with Chinese President Xi Jinping regarding Taiwan. He also stated that he expected a fair trade deal with China ahead of an upcoming meeting. This signal of de-escalation was all the Asian markets needed. The prospect of a trade truce is providing a major boost to exporter-heavy indices like the Nikkei and the Hang Seng, leading to the powerful rally we are seeing this morning. Finally, in Japan, investor confidence is also being supported by domestic political stability, following the recent confirmation of Sanae Takaichi as the new prime minister, with markets expecting a continuation of pro-growth policies. Crypto watch. Bitcoin recovers from weekend dip now. Let's turn to the digital asset space. After a volatile week that saw sentiment plunge, crypto has found its footing. Bitcoin, BTC, has reclaimed the $110,000 level, currently trading around $110,800. This is a solid recovery from its weekend lows of around $107,000. Ethereum, ETH, is also seeing a modest recovery, trading back above the $3,900 mark. Last week, the Crypto Fear and Greed Index hit a low of 22, signaling extreme fear in the market. As is often the case, this appears to have been a contrarian buy signal, as dip buyers stepped in over the last 48 hours to support the price. The rally in traditional risk assets like the Nasdaq is providing a tailwind, but Bitcoin remains in a choppy, sideways range as it searches for a clear narrative. The day ahead. What to watch looking ahead to the rest of Tuesday, October 21st. The market will be focused on two things: central banks and corporate earnings. The main event in the European session will be a speech from ECB President Christine Lagarde. Investors will be parsing her every word for clues on the Eurozone's economic health and the future path of its monetary policy. Here in the US, earnings season kicks into high gear. We are set to hear results from major bellwether companies, including Coca-Cola, Tesla, and Netflix. The reports from Tesla and Netflix, in particular, will be critical for determining if the tech-led rally has the fundamental strength to continue. That is your complete market rundown for today. Thank you for watching. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice.